care runs $9,000 a month.
So I lose everything?
15 real programs, federal and state. None of them mail you a check automatically. Combine enough of them and the total lands past $5,500 in a single year. Not from one source, from stacking several. Most people never apply for it all. Every one of these 15 runs on the same rule. The money is budgeted, it's approved, and it sits there until you say the program's name out loud. Nobody calls you first. 2 of these have a real deadline attached. One tax break on this list disappears completely after 2028. Several of the others are funded once a year, first come, first served. And when the money's gone for that cycle, it's gone until the next one opens. So grab something to write with. We're going in order, smallest to largest, and the biggest number on this entire list doesn't show up until we're 2/3 of the way through. Before we start, let me stop 3 of you from leaving. If you assume this is only for people who are struggling, several of these have no income test at all. One is a tax move for people with a full IRA. Another is a veteran's pension that isn't about being poor. If you assume Medicare already handles all of this, most of these don't run through Medicare. They run through the IRS, your state, or a food bank. And if you assume you'd already know if you qualified, you wouldn't. Almost every one of these needs a separate application, and nobody sends you the form. Quick note before we go further. I'm not a lawyer or a tax advisor, and this isn't personal advice. It's the briefing that helps you walk into the right office already knowing what to ask for. If that's useful, A-like tells YouTube to put this in front of more people our age. The grocery money. We'll start with the smallest checks, because they're the ones people wave off, and they're also the easiest to claim. Number 1 is SNAP, food assistance. And I know the reflex. You hear food stamps and you think, my Social Security is too high. That's not me. For most seniors, that reflex is wrong, and here's the exact reason why. Once everyone in your household is 60 or older, the rules change. The gross income test, the one that screens most people out at the door, disappears completely. Gone. They only look at your net income after deductions. And seniors get a deduction, younger people don't. Every dollar of out-of-pocket medical cost, over $35 a month, comes off your countable income first. Your Medicare Part B premium alone is $202.90 a month. That, plus prescriptions, plus co-pays, can pull your countable income down below the line, even if your check looks too big on paper. For 2026, a single senior household qualifies with net income around $1,305 a month. A couple, around $1,763. The maximum benefit for one person is about $298 a month. Call it $3,500 a year in groceries you're not paying for out of your own pocket. So here's a question for the comments because I read them. Did you ever apply for SNAP and get told you made too much? Tell me what year, because if it was before you turned 60 or before you counted those medical deductions, the answer you got may not be the answer you'd get today. Number 2 lives right next to it, and it's one almost nobody outside the food bank world has heard of. It's called the Commodity Supplemental Food Program, the Senior Food Box. If you're 60 or older and your income is under roughly 150% of the poverty line, you can pick up a monthly box of USDA food, cereal, canned protein, cheese, rice, shelf-stable milk. Retail value around $50 a month, $600 a year, and it costs you nothing. You can get it and SNAP at the same time. They don't cancel each other out. And number 3 is the one with a season on it, the Senior Farmers Market Nutrition Program. A voucher, usually somewhere between $20 and $80 a year depending on your state, that you spend on fresh fruit, vegetables, and honey straight from local farmers. Small money, yes, but it's real, it's yours, and it stacks on top of the first 2. Now, those last 2 share a catch you need to hear. They're funded once a year, and it's first come, first served. When a local program runs out of boxes or vouchers for the season, that's it until the next cycle opens. So these aren't someday programs. If they apply to you, they apply now. The utility money. Number 4 is money toward your heating and cooling bill, and this one moves fast in some states, so pay attention to the timing. It's called LIHEAP, the Low Income Home Energy Assistance Program. It's federal money funded through your state, and it pays a one-time benefit, typically somewhere between $200 and $1,500 a year, directly to your utility company. Not to you, to the company, which means it never shows up as income anywhere else on your paperwork. Eligibility usually runs up to about 150% of the federal poverty line, and here's the part that matters most. It's first come, first served, out of a fixed pot of money each year. When your state's allocation runs dry, the program closes until the next funding cycle, sometimes the next winter. I'll say the honest part too, because accuracy is the whole point of this channel. This program has been proposed for elimination more than once in recent budget fights, and Congress has kept funding it each time. That's not a guarantee for next year. It's a reason to use it this year, while it's here. Ask your state's energy office about one more thing while you're on the phone. Weatherization assistance. It's a separate track that pays to fix the actual problem, bad insulation, a dying furnace, so the bill is smaller every year after, not just subsidized once. Number 5 is smaller, but it's nearly automatic if you already qualify for something else. It's called Lifeline, a federal discount on your phone or internet bill, up to $9.25 off every month, or $34.25 if you live on tribal land. If you're already on SNAP, Medicaid, or SSI, you typically qualify without any extra paperwork. If not, it's based on income at or below 135% of the poverty guideline. One phone call to your provider, and you ask a single sentence, "Do you participate in the Lifeline program?" Most people who qualify have simply never asked. The state check, almost nobody applies for separately. Number 6 is the one most likely to be sitting in your account right now without you knowing it's a separate program. If you receive SSI, Supplemental Security Income, most states add their own layer on top of it. It's called the State Supplementary Payment. 44 states run one, only 6 don't: Arizona, Arkansas, Mississippi, North Dakota, Tennessee, and West Virginia. Here's where it gets confusing, and it's confusing on purpose, not out of malice, just because 2 different systems built it 2 different ways. In some states, Social Security folds that extra payment directly into your regular SSI deposit. You've been receiving it the whole time and never seen it broken out as its own line. In other states, it doesn't work that way at all. It's a completely separate application through your state's social services office, and if you never filed for it, you're not getting it. Full stop. So you're in one of 2 positions right now. Either you're already receiving this and never noticed it as its own program, or you qualify and have never applied for it. The only way to know which one is true for you is to search your state's name plus state supplementary payment and see which system you're in. Now we get to the tax return, and this is the beat with the most layers, so stay with me. Each one stacks on the last. Start with the deduction you probably already get and may not know the size of. The day you turn 65, the IRS gives you a bigger standard deduction automatically. $2,000 more if you're single. $1,600 more per spouse if you're married. That part's been around for years. What's new is the part on top of it. For tax years 2025 through 2028 only, there's an additional deduction of up to $6,000 per person, $12,000 if you're a married couple and you're both 65 or older. It starts phasing out once your income passes $75,000 single or $150,000 joint, and it's gone completely above $175,000 single or $250,000 joint. You don't apply for it separately, you claim it on the return, but a rushed preparer or a rushed piece of software skips it constantly. Ask for it by name, the senior deduction. And here's the clock on this one because it matters. This expires after 2028. It is not permanent law. If you're eligible now, the window to actually use it is 4 tax years, not indefinite. Next, Schedule R, the credit for the elderly or the disabled. This one is not a deduction, it's a credit, which means it comes off what you owe, dollar for dollar. The credit itself runs from $3,750 up to $7,500, depending on your filing status. The income limits are strict, and they don't move with inflation. Roughly $17,500 for a single filer, $20,000 if you're married and only one of you qualifies, $25,000 if you're married and you both do. It's one of the oldest credits on the books and one of the least claimed because it lives on a form most people never open. Ask your preparer about Schedule R by name. Last one in this group, the medical expense deduction. If you itemize, any unreimbursed medical cost above 7.5% of your income can come off your taxable income. Prescriptions, dental, hearing aids, mobility equipment, long-term care insurance premiums, even mileage to appointments. Keep every receipt in one envelope through the year. For a senior with a heavy medical year, this single deduction can outvalue any other item on this entire list. Let me know in the comments. Did your preparer ask about Schedule R this year, or did you have to bring it up yourself? I want to know how common that gap actually is. If you're married, everything I just covered has one more layer, and it's not a new program. It's a strategy for using the ones that already exist. When you file jointly, each spouse gets their own 65 deduction. That's not new information. What most couples miss is the coordination underneath it. You can time which spouse claims Social Security first, so the higher earner's record becomes the larger survivor benefit down the road. You can choose which spouse's name carries certain medical deductions, depending on whose return benefits more from the itemizing. None of that requires a financial advisor. It requires sitting down once with both returns in front of you instead of filing the way you always have, as though you were still two single people who happen to live together. Couples routinely leave money on the table doing exactly that, not because the rules are hidden, because nobody stopped to run the numbers as a household instead of as two individuals. Medicaid long-term care and spousal impoverishment. This is the one I told you about at the start, the biggest number on the entire list, and it's not a check. It's a protection most people don't know exists, and they write off the entire program before they ever ask about it. Here's the assumption almost everyone walks in with: Medicaid is only for people with nothing, and if your spouse needs nursing home care, you lose everything to pay for it. That assumption is wrong, and it's been wrong since 1988, when Congress built specific protections for exactly this situation. If one spouse needs long-term care and applies for Medicaid, the healthy spouse, the one staying home, is legally allowed to keep a share of the couple's money before a dollar goes toward care. It's called the Community Spouse Resource Allowance. For 2026, that's between $32,532 and $162,660 in protected assets, depending on how much the couple has and which state you're in. On top of that, the healthy spouse keeps a monthly income allowance for 2026 between $2,643 and $4,066 a month, guaranteed before the applying spouse's income goes toward care costs. And there's a second figure inside that range worth flagging. The minimum allowance is scheduled to rise to $2,705 a month starting in July 2026. So if you're planning around this, use the updated number, not the January figure. Now here's why this matters in real dollars. A semi-private nursing home room runs close to $9,300 a month. Paid entirely out of pocket, that's over $100,000 a year, draining a lifetime of savings in under 2 years. With these protections applied correctly, before you or a family member writes Medicaid off as not an option, the healthy spouse isn't left with nothing. And the difference between doing this right and doing it wrong is the difference between that $9,000 bill landing on the family every single month or being covered. This is not a loophole. It's federal law, written specifically to stop what used to happen before 1988, a healthy spouse impoverished just so their partner could qualify for care. But the protection only works if you get the actual numbers checked by someone who specializes in long-term care Medicaid rules before assets move, not after. If this is closer to your situation than you expected, tell me in the comments whether it's a parent, a spouse, or yourself you're thinking about right now. It changes which of these numbers matters most to you. VA aid and attendance. If you or your spouse served during a wartime era, this next one is worth stopping for because it's one of the most overlooked benefits the VA offers, and it has nothing to do with a service-connected injury. It's called aid and attendance, a tax-free monthly pension add-on for wartime veterans, and for their surviving spouses who need help with daily activities or live in a nursing facility. You do not need a combat injury. You do not need a disability rating. This is a needs-based pension, not a compensation claim, a completely different program from VA disability, and a lot of veterans never apply because they assume disability is the only door in. For 2026, the maximum comes in around $2,874 a month for a married veteran, lower for a veteran alone, and up to roughly $1,558 a month for a surviving spouse with no dependents. I want to be straight with you on this one. These figures come from current VA cost of living adjustments reported by veterans benefits organizations, not a figure I pulled directly off of VA GovTable today, so treat that number as up to. Confirm your exact tier with a VA accredited claims agent or the VA directly, and don't assume the maximum is what you'll receive. Your actual payment depends on your income and medical costs. There's also a net worth limit, sitting around $163,000, and the VA looks back 3 years at any assets transferred for less than fair value. So this isn't a same-week fix if there's been recent gifting, but for a wartime veteran or widow living on a fixed income and paying for home care, assisted living, or a nursing facility, this is money that's earned, not means-tested charity, and it's one of the most underclaimed benefits in the entire VA system. Qualified charitable distribution. This next one isn't a check that lands in your account. It's a move that keeps money out of the IRS's hands in the first place, and it's built specifically for people at the stage of life where required withdrawals become mandatory. If you're 70 and a half or older and you have a traditional IRA, you can send up to $111,000 a year directly from that account to a qualified charity. It's called a qualified charitable distribution. The transfer has to go straight from your IRA custodian to the charity. It never touches your own bank account. And because of that, it never counts as taxable income on your return, not a deduction you claim later, money that simply never shows up as income at all. Here's why that matters beyond the tax bill itself. That distribution counts toward your required minimum withdrawal for the year, so it can satisfy an obligation you already have. And because it keeps your reported income lower, it can also keep you from getting pushed into a higher Medicare premium bracket the following year, a cost a lot of retirees don't connect to their IRA withdrawals until the bill arrives. This one won't apply to everyone on this list, but if you're charitably inclined and sitting on a required withdrawal you don't need for living expenses, ask whoever manages your IRA about a QCD by name. Most custodians can set it up in one phone call. Capstone. The one that unlocks the other 14. So which one is the biggest? I told you at the start it wasn't the number one item on this list. And it isn't the Medicaid protection either, even though that one carries the largest dollar figure. The biggest one is the one that makes sure you actually use the other 14 correctly. It's free expert help, and none of it costs you anything. The IRS runs tax counseling for the elderly and VITA, trained volunteers who prepare your return and know to ask about Schedule R and the senior deduction. AARP runs a separate free program called Tax Aid. For anything Medicare related, every state has a free SHIP counselor whose entire job is sitting down with you and figuring out what you qualify for. And your local area agency on aging is one phone call that connects you to nearly everything else on this list. You don't have to sort 15 programs out alone. That's what these offices exist to do. Picture a widow named Eleanor. Modest Social Security check, paid off home, always assumed none of this was for her. She picks up the senior food box, worth about $600 a year. Her state runs the supplementary payment automatically, and she never knew to look for it as its own line. LIHEAP covers a chunk of her winter heating bill, and her preparer finally asks about Schedule R. None of that came from one source. It came from stacking 4 or 5 of these together, and for Eleanor, that combination lands right around the number in this video's title. One warning before you go make these calls. Every program on this list works in one direction. You call them. If someone calls you first, claiming to be from Social Security or the VA, saying you're already approved and just need your bank information to release it, hang up. Call the number on your own card or statement instead. Pick one from this list, the one that felt most like you. Go make the call this week.